In a world where economic power often defines political influence, trade has become one of the most potent tools of diplomacy. Tariffs, once seen as relics of a more protectionist era, have made a dramatic comeback in global policymaking, especially in the hands of the United States. Over the past few years, the U.S. has recalibrated its trade approach, leveraging its massive consumer market to negotiate more favorable deals. In many cases, this has worked. The European Union has signed onto trade arrangements valued at over $1.3 trillion USD. Japan has followed suit with concessions estimated at $500 billion US. Other countries, from the UK to Brazil, have adjusted tariffs upward to preserve access to the American market. But amid this trend of compliance, one country has stood apart: China. In the most recent round of U.S.-China trade negotiations, little appeared to change. A 10% tariff on Chinese goods remains intact. A 20% levy on fentanyl-related materials was reasserted. And yet, the United States agreed to extend the truce until November 11th. What may seem like incremental adjustments actually signals something much deeper: a broader recalibration of international trade dynamics. China, unlike many of its counterparts, has refused to concede to unilateral pressure. And this isn't just symbolic. It represents a deliberate strategic posture, backed by economic scale, industrial strength, and political will. Let's first understand why so many nations have yielded to U.S. demands. The most compelling answer is simple: the U.S. consumer market is unrivaled. With an annual consumer expenditure exceeding $7 trillion US, the U.S. remains the largest single market for goods and services globally. Access to this market is, for many economies, essential. Companies that lose it can face dramatic hits to revenue, employment, and competitiveness. This gives Washington enormous bargaining power. Tariffs are used not just as penalties but as instruments of negotiation, offering market access in exchange for regulatory concessions, strategic alignment, or favorable trade terms. Part of the U.S.'s economic gravity stems from its consumer culture. Spending is driven not just by income but by a strong willingness to borrow. Credit card usage is widespread. Financing big-ticket items, from homes to smartphones, is commonplace. The prevailing philosophy often emphasizes living well today, even if it means paying tomorrow. This consumer behavior has built a uniquely powerful market, creating opportunities for exporters across the globe. For multinational corporations, the sheer volume of sales in the U.S. justifies complex trade-offs, including tariffs and compliance with evolving U.S. regulations. Contrast that with Europe. The European Union has a larger total population, over 450 million, and strong economies. But it lacks the market cohesion of the U.S. Each country maintains its own language, legal frameworks, consumer preferences, and certification systems. For a company seeking to sell across the EU, adapting to local standards adds significant cost and complexity. Even large brands often find it easier to standardize products for the American market than to navigate Europe's fragmented terrain. Other global regions offer promising alternatives. Southeast Asia, India, Africa, and Latin America boast large populations and growing middle classes. But the challenges are real: logistics, regulatory hurdles, limited infrastructure, and relatively low per capita purchasing power. While the aggregate market size might look impressive on paper, the individual consumer value and short-term profitability often remain lower than in the U.S. And this brings us to China, a country uniquely positioned at the crossroads of global production, consumption, and innovation. With a consumer market valued at over $5.5 trillion USD, China is now the world's second largest. But more importantly, its economy is transforming at a rapid pace. From manufacturing to technology, from exports to domestic demand, and from fossil fuels to clean energy. China is pursuing a long-term strategy that de-emphasizes short-term market access in favor of structural independence. In the energy sector, for example, China is dramatically reducing its reliance on oil imports, especially from politically volatile sources. Instead, it has invested heavily in renewable energy, becoming the global leader in wind, solar, and hydropower installation. It is also dominating global sales in electric vehicles, accounting for a significant share of exports in this fast-growing sector. In essence, while some countries are entangled in commodity dependence, China is pivoting toward self-reliance and future-facing industries. Similarly, in manufacturing and high-tech, China continues to climb the value chain. While it still faces obstacles, such as access to certain foreign semiconductors, it is closing the gap through heavy investment in R&D, talent recruitment, and domestic production capacity. In many respects, China's economic model is shifting from factory of the world to innovation hub of the future. So while the US applies tactical pressure, such as tariffs or sanctions, China is playing a strategic, long-game approach. It is resisting short-term concessions in exchange for long-term economic positioning. At the negotiating table, this makes China harder to coerce. It's not just about refusing to sign a particular trade clause. It's about operating from a different philosophy altogether, one that sees global integration as a process that must be mutual, not dictated by one side. This divergence is also reflected in global infrastructure strategies. While the US increasingly emphasizes economic containment, reshoring, and technological barriers, China is doing the opposite. Through initiatives like the Belt and Road and regional trade partnerships, it is expanding its trade footprint, building new ports, railways, and logistics corridors from Asia to Africa to Latin America. China is also reducing trade barriers with dozens of countries, including through the upcoming Hainan Free Trade Port, which promises to become a globally open commercial platform. But what about US dominance? The reality is that America's economic supremacy is not without vulnerabilities. Its purchasing power is largely maintained through the privileged status of the US dollar, still the world's primary reserve currency. This allows the US to borrow at low costs, run large deficits, and import more than it exports. When domestic inflation rises, the Federal Reserve adjusts interest rates, drawing global capital into US bonds. This dynamic supports US consumption, but also creates dependence on external financing and confidence in dollar stability. But what happens when that confidence begins to erode? If too many countries begin diversifying their reserves, or if trade flows increasingly bypass the dollar, the US will lose a key pillar of its leverage. This is not a distant hypothetical. It's already happening in small ways. Bilateral trade agreements using local currencies are rising. The digital yuan is being piloted in cross-border settlements. And global institutions are slowly adapting to multipolar finance. It's not just about resisting US pressure. It's about building a competing model that other nations find attractive. China is promoting a system based on lower trade barriers, inclusive partnerships, and long-term infrastructure investment. It is making inroads in Africa, Latin America, and Southeast Asia, often in areas where Western engagement has been inconsistent or conditional. At the same time, the cost of doing business with the US is rising. Tariffs, sanctions, and political volatility have created uncertainty for many global firms. The risk of being caught between geopolitical crossfires is pushing many companies to hedge and explore alternatives. According to projections from institutions like the World Bank and IMF, China is on track to become the world's largest consumer market within 5 to 10 years. This shift will alter trade routes, investment patterns, and supply chain decisions. Companies that once looked only to the US for growth will increasingly turn east. The result is not an overnight revolution, but a gradual eastward tilt in the global economy, one that may define the next era of globalization. So what does this all mean? The current US-China trade negotiations may appear modest in immediate outcome, but in the bigger picture they are a symbol of transformation. While many countries are recalibrating to fit within a US-centric trade framework, China is building something new, and betting that others will follow. It's not about who wins a tariff round. It's about who defines the terms of the next global economy.